Hey, welcome back. My name is Ryan, and today we're going to be doing another ETF battle. I've got a good one. It's ARKQ versus IDRV. One is an autonomous technology and robotics ETF. The other is a self-driving EV and tech ETF. So we're going to compare these two exchange-traded funds in a head-to-head battle. And I think you're really going to enjoy it because from my last video I did back in January, everyone seemed to really like the head-to-head comparisons. So without further ado, let's get into it. So today, if you look here on my screen, I've got both these ETFs side by side. I'm actually going to link these down in the description, so make sure you check that out. But first thing we're going to look at is what is it? So if you look at ARKQ, like I said, it's an actively managed fund with a broad mandate to invest in companies benefiting from automation and other tech advances. ARKQ is a Cathie Wood fund. I've talked about that many times. I'm actually going to link one of those up here, one of those videos to check that out. The other is the iShares self-driving EV tech and ETF. That is not obviously an ARK investment ETF. So, and if I look over here, the first thing I want to look at is the inception date. So ARKQ does have a longer track record of investment coming up on 10 years, while the IDRV is only a few years old, as we see here on the April 16th of 2019. The next one is really big, the expense ratio. The expense ratio almost, we've got 75 basis points here and we've got 47 basis points here. So that's a big one. We do want to keep an eye on expenses. I've talked about many times. I can't stress this enough. Watch those expenses. They could kill your portfolio over time if your rate of return is not taking that into effect. Assets under management, we've got almost $1 billion here and we've got about $500 million here. We can see the index track. There's no underlying index, and over here we've got a autonomous driving and vehicle index. The fund is open-ended. Same thing over here. All that means is they're continually taking investments into the fund, where a closed fund, which I've again talked about on this channel before, does not. Once it's closed, you can't add any more. There's no more funds coming in. There's no more equity to be purchased. So when I move down here into the chart, if I look over at the 5-year on each, you'll see that the ARKQ has done very well, but actually the IDRV has done even better. And if you do look up here real quick, you'll see the rating that ETF.com gives it. I'm going to give it my own rating here at the end, and obviously from the last video you saw, I'm going to give you a clear winner. So again, we're going to go head to head. We're going to see how they come out. If I go down here, I can look at the 5 years, 9%. The 3-year on this is 23. The 3-year on this is 14. So the IDRV is doing better, but it doesn't quite have the track record that the ARKQ does. So it's something we're going to continue to watch. All right, as I move down, probably where the meat of this starts to come in is what's in this thing, right? What's the P ratio, all the pedigree stuff? We're going to go into that right now. So the weighted average market cap, 152 billion versus 53 billion. We knew this. The assets under management are almost double for the ARKQ versus the IDRV. That's okay. We're not worried about the assets under management right now. We're worried about more important things like price to earnings ratio. So in this case, it actually has a negative price to earnings ratio. Wow. So what does that mean when it comes to, we look over here, and this ETF actually has a PE ratio of $1,236 or dollars per earning. So basically what that means is you're paying $1,236 now for $1 of earnings later. Very high, very high. So that tells me one of two things. Either people are expecting this fund to rapidly shoot up in price over the next 12 to 24 months, saying like, hey, we're gonna get a massive infuse of liquidity. We're going to get some money pumped into this fund, or they just, it maybe has ran up too much. We're going to look at that in a minute. Over here, though, if I look at something like the distribution yield, that's the percentage that they're paying back to their customers. Again, 2.11% to the 1.52% here. Not a big deal, but it's good that they are distributing dividends out, and they're making sure that they're taking care of their customers. So next, the next time we see an upcoming dividend, actually we don't see one here on this fund, the ARKQ fund, but on the dividend date for the next one, this date is being recorded on March 31st. So we're looking at a dividend on June 7th. Now, this is the next part I'm going to go into is very important. Number of holdings. So I've talked about diversification. I've talked about the need to keep things in your portfolio, even if it's that 50 30-20, maybe it's the 60-40, whatever it is, but don't concentrate everything into one ETF or even one unit. So in that case being all ETFs, all cash, all bonds, all mutual funds, etc. Make sure we're spreading that out so we're building a portfolio that can withstand what we're currently going through during a recession, high inflation, and even higher interest rates. But this is important. So we have 37 holdings in this fund, and we have 60 over here. This tells us we've got more diversification in this fund over here, but the return and the track record is a little better over here. So again, something to think about. Most of these in this fund is going to be in the United States. So we see a almost 90% correlation to country in the United States. And then we see one of the biggest holdings is Tesla. The biggest holding in this fund is Tesla. And it doesn't really surprise me. Kathy Wood is a very big bull on Tesla. She's continually talked about it. She continually moves in and out of Tesla, buying low, selling high. But it's definitely a big winner here. The other one in this ETF is NVIDIA. I think NVIDIA, and I think I'm going to do a video on this. You guys have to let me know in the comments below. I think I'm going to do a video on NVIDIA stock, as well as the company, and how it's really poised, I think, to be the #1 beneficiary of the new ChatGPT, GPT-3, and GPT-4. I'm going to do a video. I think I'm going to do a video on that explains why I think NVIDIA is such a hidden gem in the AI space. That notwithstanding, let's look at the comparison over here. So you're getting a lot more diversification in other countries in this ETF and the IDRV ETF. So you see United States is about a third, Hong Kong, Germany, Australia, Switzerland, etc. If I move over here though, you'll see a much more evenly spread amount of the capital going into the funds. So again, we've got 60 funds here, and each one is about 5%, at least the top 10. And we do see Tesla on this list, but it's much lower than what we see over here in Tesla. So in this fund, we've got 14%, and in this fund, we've got about 4.5%. So if you are into Tesla and you want that bigger representation in your portfolio, ARKQ might be the way to go. If I look at the sectors in this, we see consumer durables, and in this case, we see electronic tech sustainability, consumer durables, and producer materials. But in this case, 31% is going into electronic tech, not surprising. We've got Tesla, we've got UiPath, which is actually a robotics like chatbot type of company, Teradyne, Iridium, and NVIDIA. Those all help the electric tech. As you know, Tesla has in the past ran NVIDIA GPUs for their self-driving cars in their Teslas. Okay, moving down, next round, we've got the expense ratio, which we talked about a little bit here, 0.75. That's not good for ARKQ. They better have some outstanding returns. And you're looking at an expense ratio of almost 20. That's 28 basis points lower. So that's definitely gonna make it interesting here. As I move further down, I can look at the daily. I can look at the spread volume. I can look at the share volume. You want to see high share volume. Let you know institutional investors are interested in this. If you're not seeing a lot of volume, it's probably individual investors, which again could be something that you're not that big of a deal. But it's always good to see heavy volume being traded. It lets you know that people are interested. It lets you know that institutional funds like pension funds, retirement funds, hedge funds, they're all interested in owning this. We see the daily volume. I'm gonna actually move down here. Net asset value, $47, and we've got $37 over here. As I move further down, actually, we're gonna go over some of the info that I went over just a minute ago again. But one of the things that I think is interesting here is if I move down again, I see the dividend yield 0.34, and then I see the dividend yield over here, concentration medium, and then concentration high. I think it's important to note that if I scroll all the way back up here, I'm going to do a comparison of these two right now, actually. So if I go in and I compare the IDRV right here, I'm going to do a layered approach, and boom, what do we see? Over the last, what has it been? So this was, the inception date was May of 2019. So we're about almost 4 years in. we see that they are almost neck and neck. So ARKQ is beating it by about 2%. But again, we've got the higher expense ratio, and that's something we need to keep in mind. We've also got a little bit better dividend on the IDRV side. So that might be something to look at as well. And then if I move down here, I can actually see year to date, they are neck and neck when it comes to 2023. So, I mean, we're looking at negligible. So in this case, ARKQ is up a little bit, but again, the expense ratio is a little higher. But if I go back, I think it's important to look at track record as well. So the ARKQ has been it was incepted in 2014. The IDRV was incepted back in 2019. I can't stress this enough, and I have people that call me and ask questions. Hey, what's the better fund to invest in? It really just depends. But in this case, if you were looking at ARKQ back in 2021, February 19th, you're looking at 429% compared to 88%. In that case, it's worth paying more your expense ratio could be higher even with a lower dividend yield because of the outsized gains that you've accumulated in such a short amount of time. And I will say, look at what happened. So everything ran up right before COVID hit. This was February of 2020. For those that were in the market and remember that was right before COVID hit. Everything bottomed out, so you really had a good price there. IDRV actually went negative from its initial IPO, and then everything just shot up. Not surprising. The ARKQ ETF is outsized and overweight in Tesla, and Tesla just skyrocketed as the price of cars and the price of materials and everything really got tightened due to supply chain and monetary issues throughout the world. And then everything started to go back down as we saw interest rates rise, and we saw people moving in and out of some of those over-levered sectors. So all that being said, which one do I choose? Which one wins here? I'm actually going to go with ARKQ, and there's two reasons for that. Number one, I have a very favorable and strong opinion of Cathie Wood. I think she's absolutely fantastic. She's investing only in the companies such as automation, biotech, gene therapy with CRISPR, and then robotics. So, those are just four areas that are going to continue to grow. Number two, and again, I've talked about this in other videos, it's the track record. It's always, for me, it's the track record. I like to see what you've done in the past, how you've handled that adversity, because every fund's going to go through that, just like back in 2008, 2000, 93, 98, or 88, 74. I can just keep going back, all these different instances where we've had a recession or we've had some kind of higher inflation. So that's the other reason. I'm not too concerned about the higher expense ratio given the fact that ARKQ has outperformed IDRV over the last 4 years, but we'll see, right? I'm not against IDRV. I think the ARKQ, even though it has less, it's got a smaller concentration of equities underneath it, I think ARKQ still in another year or so will do better. So what are your comments? Leave them down below. If you like these type of videos, let me know. I do enjoy doing the head-to-head battles. Please let me know what you'd like to see. And as always, don't forget to design your financial freedom. Take care. Bye-bye.